pleasure to be here. It's frightening to be here. Next month will be the 20th anniversary of my graduation from this place, and it's frightening to think that I'm 20 years older than most of you on average. So, but it is fun, and hopefully you'll have fun doing this one day as well. What I wanted to talk about today, first I'm going to give you a 5-minute sales job on Costco, so if you're not a member, you will be by the end of today. Secondly, talk a little bit about the growth. Of course, you know, sometimes people ask me, how did I know Costco was going to be big and successful, and why did I decide to go there? And I had no idea it was going to be this big and successful. How did I get the job? A combination of luck and more luck, and making, you know, a lot of chances for luck. And despite the fact that I had an MBA, they hired me, because typically a lot of big businesses, a lot of startup general businesses like Costco didn't go out to the top business schools in the country to recruit. I think what I had going for me was not only did I have a pretty decent education, I grew up in a grocery store. My dad had a grocery store, so I knew all the one-syllable terminology that was involved in Costco. But as the dean just shared with you, when I first got there, people were stopping me in the hall, asking me to come. They're so glad I'm there because everything is screwed up. The systems doesn't work. The accounting department, the controller had quit out of frustration. And so I viewed this as my next one-year job before I went back to Wall Street and lived happily ever after. And fortunately for me, one of the things that I did learn in my career at DLJ for 4 years, both 2 before and 2 after business school, was how to recruit. And we were fortunate to early on get a very good controller on board and a very good head of EDP at the time, which then became IS, and now it's called IT. And that helped quite a bit. But certainly a lot of it has been learning. And probably the biggest thing that I learned was that I knew I didn't know was how to be a manager. One of the things that you learn when or that you experience when you're here at business school, or for those of you who have worked in banking or consulting or those types of things, that you're around a fairly homogeneous group of people that all have the same levels of motivation to work hard and get ahead. In most businesses, not everybody, and certainly when you're learning, you're constantly learning how to be a manager, not everybody has the same levels of skill or the same levels of motivation. They all bring their own issues to work, both personal and business. And boy, have I learned how inadequate I am as a manager, and how every day I have to learn to be a better manager. And when it was the 20 people that worked in those various functions that I talked about, or the 800 or 900 that work in those various functions today that report up through to me. And people that know me that can't believe I'm in charge of all the things that are administrative related, because I am not very organized. So every night I spend about an hour on a yellow piece of paper, not on a Palm Pilot yet. I do have a Palm Pilot as a Rolodex, but a yellow piece of paper, just writing down my little notes and of what I'm going to do the next day, and it helps. So with that, let me start. I'm going to talk a little bit about Costco, talk a little bit about the growth of Costco from really 300 employees when I got there to nearly 100,000 today, from nearly 40 billion in sales today, from back then when it was 100 million in its first year, and talk about some of the things I think have made Costco successful, my experience as a CFO, and touch lightly on a few topics of interest of late, like the role of the audit committee. I don't know how companies are going to be able to find people that want to sit on audit committees, and the things of that nature today. And the whole issue about earnings, revenue recognition, pro forma earnings announcements, and you know, what is pro forma. We're kind of lucky in that regard. We buy mayonnaise and sell mayonnaise. We have a very easy income statement and balance sheet to understand and follow. We don't have a lot of issues with revenue recognition. We don't have a lot of derivative issues. So a lot of these new FASBs haven't affected us like they've affected a lot of companies in Silicon Valley. Oh, is this it? Yeah, let's try this. Okay. That's just a picture of a Costco, if you haven't been to one before. They're 15-acre sites, 150,000 square feet, 1,000 car parks. This one is in West Los Angeles, and the powers that be down there make it look like it's not a warehouse. Inside it is cement floors and steel racks, but from the outside it looks like the Stanford Mall. There's actually only one entrance, and that's it right there at the corner. They're happy, and we're happy. Today, we're the 9th largest retailer in the U.S. This year, we'll do $38 billion in sales for our this year end. We'll generate a little over $1 billion in pre-tax earnings, pretty much a full taxpayer. We have just under 400 locations. About 80% are in the U.S., along with 6 other countries. Probably half of those states, of the 36 states we're in, we've entered just in the last 7 or 8 years. One of the numbers we're most proud of is the fact that our average warehouse has $101 million in annual revenue. Structurally, in our industry, we do high volume. But even the other 2 industry players that are left in our business, Sam's, which is part of this big bad company called Walmart, and a smaller player on the East Coast called BJ's, our 101 compares to Sam's 60 and BJ's 45. And about 10% of that difference is square footage, but the majority of it is we've cultivated an upscale customer and selling them very upscale products at great prices. We're big. Not only do we do 38 billion in sales, we have almost 50 million square feet of retail space, and as I mentioned, almost 100,000 employees. And again, so we can proudly pound our chest thinking, boy, we're really a big company and successful company. To put this in perspective, Walmart as a company will open about 49 million square feet this year. So they're opening a Costco every year. And that keeps us paranoid and on our feet and on our toes and being ever more competitive. At the heart of our business is one of those 22 million cards the Dean just showed you. We have 22 million member households, including free spouse cards, almost 40 million people walking around with a Costco membership card in his or her wallet. Our renewal rates are the highest they've ever been, and for those that have done demographic stuff before and statistical stuff, 86% loyalty is an enormously high number. We have states where we have 60% of the households as members. And these are people that pay us now $45 a year, and or $100 if they want to be an executive member. And it's certainly a big part of our bottom line. $750 million on $1 billion pre-tax. We really don't look at it that way. We've been asked the question: do you basically do everything to break even and make your membership fee? I guess you could look at that. We'd like to make more than that. The fact is it's part of our loyalty and part of our pricing. It's about 2% of sales. So when you come in, it's created not only once we've gotten you, you're loyal because you've made this investment in Costco. You want to prove that you made a good investment, so you're going to buy more things with us. But when you look at a television for $200, you don't think, well, it's really $204. So it's an added price advantage to us when customers are looking elsewhere. I think this comment sums up as much as any of the comments. And again, we have been well received and well respected by our customers. This was a statement by one of the analysts at Alex Brown a few years ago. But Costco's created a franchise, a brand that stands for quality and great prices, and continues to wow its customers. I think part of our success has been that every day we don't stop thinking about wowing our customers. I remember back when I first started, and there was only Price Club and Costco, and then all of a sudden Walmart opened in the business, and a couple of others opened the business, and I was kind of bummed because I thought this thing was going to go, be real profitable real fast, and stock was going to go up, and all of a sudden we have all this competition. And that old adage that competition is good for you, it does work, and it creates a little paranoia, but it does keep us on our toes. And I think that and I'll share with you some of the things that we do, that we are constantly trying to wow our customers. Inside view. Brand names like you've all seen on the food side, as well as the non-food side. Many of these vendors on the non-food side 10 and 15 years ago would not sell us. A few of them still won't sell us, but we know how to divert their merchandise. It's amazing. I'll just give you one quick anecdotal story. We always diverted Waterford Crystal, and we'd sell it at 30 and 40% off of retail. And whatever we could get our hands on, whether it was 10,000 goblets or 1,000 vases or whatever it might be. And there was an instance where we were victimized by buying some counterfeit Waterford goods that we had then sold to our members. Fortunately, it was a small batch. We got the call from the lawyer, and usually when the lawyer from a Nike or Adidas or a Waterford calls, they want to sue you and they want your sources and all that. And of course, we fight them because it's perfectly legal to sell legitimate goods. Well, in this case, these weren't legitimate, but they were very cordial, being British, and Irish, excuse me. Anyway, they were more concerned about getting real stuff in the hands of the customers. And of course, with our database and the fact that we know what everybody buys, we were able to quickly pull that together. And when we asked them, they were shocked how much stuff we had been diverting legitimate goods, and how much we were actually selling of their product. They were shocked. It worked out. We not only were able to buy enough to replenish this limited amount of counterfeit goods, we were able to buy more for the Christmas season to sell. And we are now, I believe, their largest customer. In fact, it was the largest single order that was ever placed with them in their multi-hundred-year history. And that's what we're all about, is limited selection, but a very high volume of goods. And more as the channels change, we're able to find those goods. We're the largest wine seller in the country by a factor of 2, and the largest fine wine seller in the country by more than a factor of 2. We literally have customers in some, like Palm Springs, retired customers that literally find out when the yellow freight truck is arriving to come in and get their limit 2 per person, and they'll bring their wife and their next door neighbors so they can get 6 bottles. Something like this. We sell over $100 million of MCI cards at successively lower pricing. And anybody can get this price as long as they commit to about 5 billion minutes a year. And you talked about diamonds. We'll sell over 50,000 carats of diamonds a year. And the guarantee on the diamonds, on any sub 2 carat diamond, it has to appraise for at least twice what you paid for it. And any more than 2 carat diamond, at least 1.5 times what it appraised for. That's partly a function of the fact that there's a lot of markup in diamonds, and that we can provide a really tangible savings. We have special order diamonds where you can go on the website, put in your carat size, cut, color, clarity, and we'll come back to you within 24, 36 hours with a guaranteed quote and a supply. And someone might be embarrassed to say, I got my fiance's ring, or my fiance got me my ring at Costco, but the fact is 50,000 people are doing it. Electronics, game electronics is very big right now with Xbox, and we're buying direct from all those guys. Books, there was a nice article about 3 weeks ago in the Wall Street Journal. We will represent, not our industry, but just Costco. When a bestseller comes out, we are typically 10 to 20% of the volume of that book over the life of that book, over the first 6 months of the life of that book. So we have an enormous power now with the vendors. It's because we'll make 5 or 10 or 15 cents on a $15 cost book that everybody else is retailing on sale for $19.99. Electronics, we're the largest supplier of compact computers. Sony just started selling direct, and I assume that we'll be doing a pretty good job with the Vios as well. Jeans, for 15 years, Levi told us, no, don't even come near our booth at the show. Of course, Levi's had its own set of issues in the denim industry and the retail apparel industry. A combination of those two things has helped us. We just went direct after 15 years of diverting $10 or $20 million a year. In the first year, we'll do nearly $200 million with Levi, or close to 200,000 pair a month. 200,000 pair a week, week in and week out. They've taken notice, and now other apparel manufacturers are taking notice. We're the largest seller of USDA choice beef in the country. I bet you didn't know all this stuff. Giant cakes, oversized everything. Pies. The week of Thanksgiving, we sold over 1 million pies, including 700,000 pumpkin pies. Our less known claim to fame, though, is we were actually the pie used in the movie American Pie. Apparently, Universal Studios that day went over to the Van Nuys Costco and bought 6 apple pies. So, produce. Our version of a road show, we'll bring in 4 or 5 times a year, usually over Memorial Day and July 4th. Really good-looking, big, oversized stuff at half the price of the local grocery store. 100,000 pizzas a week in store. These are the ones you take home and bake yourself. The biggest problem we've had with this is customers complaining that our 18-inch diameter pizza is too big for their oven, and arrogantly we say just curve up the sides. So, because we want it bigger. Private label has been an avenue for us to drive volume and save the customer money and enhance our margin in some instances. We do a lot of private label for different reasons. We do a private label tennis shoe because Nike, Reebok, and Adidas won't sell it. We're selling a $50, $60 all-purpose leather tennis shoe for $13.99, and we'll do close to 2 million pair this year. In this case, we can save the customer 30% and make just as many gross margin dollars as a leading national brand. So again, everything we do is to try to save the customer money, and with that religious fervor, that's what we do. The shirt I'm wearing, the shoes I'm wearing, I did that on purpose, by the way, today. The underwear I'm wearing, I'll stop there. These are all items. This pair of shoes is a basic $120 loafer that you'd buy at Nordstrom's, but in this case, it's Kirkland Signature. It's spec'd so that it's a thicker stitch. It's going to wear out less frequently, and we're going to sell it for $29.99 instead of $120. Our president can't wear it because he's a double E width, and we don't sell that because we have a limited selection. We're not going to sell the outlier bell curve sizes because we can't afford to mark them down at the end of the season. This shirt is $18 instead of $40. We have big pharmacy operation, optical. The last 2 years, Consumer Reports, and I learned from my attorney the other day, our in-house counsel, I'm not allowed to use the name Consumer Reports in a commercial advertisement here. So this is a Consumer Report. But we were the #1 optical store in the country. 20 million rolls of film. I'm almost done with the sell job here. In this case, the gas stations. This was the front page of the San Francisco Chronicle last July, where we were saving 30 to 40 cents a gallon on gas in an environment where everybody was cognizant that the gas companies are screwing you. And we got so much free publicity. We do no media advertising. We were on every news station and every newspaper, on the local Consumer Report news in every part of the country about how wonderful Costco is. We were the pioneer of this and among discounters. Now, of course, every supermarket chain and every discount store chain is putting in gas stations. But that's what we have to do. We have to stay ahead of the game. This is actually the typical day at Irvine, California Costco, where we've had to redirect the parking lot. People will wait 20 minutes online to save $3 on a tank of gas because of the principle that they're saving money. Some people will. Special order items here. Is it working? Oh, there. Let's try this. Just some more special order items. We sold $40 million of leather sofas in 2 months by just having it out there with people to touch the leather and see the sofa. For some reason, this isn't working now. Why don't we just use this? Okay, so why have we been successful? One, we've had a lot of great items, and we continue to wow you. Structurally in our business, great value propositions. Structurally, the warehouse club business is the most extreme form of retail in terms of pricing. Low-cost operations, high sales productivity is generated by that, and that starts that productivity loop over and over. So the more we sell, the lower our operating costs, the lower we can even charge, and then we'll sell more because it's a lower price. Membership is certainly a great enhancement and value to us. Once we've got you, and if we can keep earning your loyalty and trust, it's going to be that much more difficult for other retailers to compete with us. And we're capital intensive. What was originally 8 industry participants in 1983, 4 and 5, is now 3, with us being about 55% of the industry, Sam's, which is Walmart, being about 40%, and BJ's being about 5 or 6%. From a company standpoint, hopefully you've gotten some of this obsession that we have of driving prices down. It drives me crazy. My dad in his grocery store would take a 19-cent can of peas and put it on special 5 for $1 and sell the hell out of it because it was 5 for $1. And we made a penny more per can. We are just the opposite. Everything we do, if we can save $1, we want to pass on 80 or 90 cents to the customer. If we will never upsize an item in terms of putting more packages in, go from a 12-pack to a 15-pack of paper towels unless we can lower the price per unit. I think our company, we're obsessed with getting brands that refuse to sell us. Every buyer's bonus is based, among other things, based on brands that won't sell us, including things like Godiva chocolate and Estee Lauder cosmetics, neither of which we had directly. Estee Lauder personally has said never will she sell us. I'm happy to report that she's, I think, in her early 90s now. So, but the fact is that's what we do. We try to wow our customer. As big as we are, we have very clear channels of communication. We're on a first name basis. Our phone lists are. I'm under R for Richard. Every 4 weeks we have a 2-day budget meeting with about 70 people from around the world that come in. You're only allowed to miss it if you've died, and everybody's there, and everybody sits through everybody else's presentation, whether it's budgets, IS, the rewrite of the membership system, and what that's going to do for the warehouses, marketing and membership, whatever it might be. We keep it simple. The policy in the warehouse is very simple. And no policy can be more than a page long, because 300 warehouses don't have time to figure out how to build airplanes. And recognizing we're in a simple business, so it's easier to have simple procedures. I say no consultants, kind of tongue-in-cheek here. I know some of you have worked for consultants and some of you may. Our philosophy from a strategic planning standpoint is if you don't know how to do it, we'll find somebody that does, but they're going to work for us. Part of it is we're cheap. We don't like to spend a lot of money. And part of it is because we like to keep things simple, we probably have a reverse attitude of arrogance, thinking that consultants try to complicate things. So it's served us well. It's not for everybody. I think sometimes we're a little short-sighted, not on the strategic side, but even on looking at the ways that we can do things. That probably we could get some help from that, but that'll change over time, I think. Highest wages and benefits. For hourly retail, we have one of the lowest turnover statistics. It starts by paying our people better. A cashier in his or her 5th year of operations on an hourly basis is going to make $41,000. Whether they have 1 child or 9 children, they have one fixed rate, which is a fraction of what others charge for the employee participation in cost of medical, health, and dental. And we provide, hopefully, as we keep growing, we provide a good opportunity for them to grow. Generally, no backstabbing. I mean, we're a very non-political company. People, when they're there, whether it's vendors or bankers, they look around. People are generally having fun. I mentioned the open door policy. Everybody's door is open. Jim Sendergo, our president, answers his own phone. I answer my own phone unless I'm on the phone already. The fact is that anybody can come to anybody. Go through the channels, the proper levels. But if you're having a problem with something, see whoever you need to see to help get it solved. We're nimble. As big as we are, we change things quickly. If we screw up something, get it out and do it right, or don't do it anymore. If something works, like you saw the special order items, like the bathroom fixtures and the sofas, we tested that in 10 locations. It worked. 2 months later, we started planning to roll it out to 300 locations, and within 3 months, it was everywhere. We should respect our suppliers. We want to be tough as nails with them up front. But once we've set a deal, we live by the deal. We don't then go in and ask them for more things until the next go-round. We pay on time. In other words, we take our discounts. If it's 210 at 30, we're going to pay on 10 days. I can't tell you how many well-respected retailers we're told by our vendors that will purposely pay an extra couple of days late to get extra float. If you want to do that, negotiate it into the deal. We have a 2-year rule on termination of a supplier. This is for the P&Gs of the world. It's for the smaller companies that. You know, if we've taken a small mom and pop company at $10 million and now they're $40 million, if we decide not to sell those items anymore, we can put that company out of business. Any vendor that's being terminated that's been a vendor for more than 2 years has to be approved by Jim or Dick DeCercio, our head of merchandising. Not to say we won't terminate them, but we'll do it over a period of time to help ease out of the pain. Okay, that's the Costco sales job and how wonderful we are as a company. In terms of some of the financial stuff. In terms of valuation of the company and funding of the company, it's been a pretty classic chronology of financings. In February '83, we raised $7.5 million of startup equity that bought half the company. The deal that I was fortunate enough to work on and fortunate enough then to be invited to come work for Costco was in December of '83. We did a $17 million mezzanine round that valued the company at 5 times pre-money. A year later, we did a second mezzanine round of $30 million. That was actually a $20 million round that we went out with to traditional institutions, and the largest retailer in France, Carrefour, bought 150% of the deal, and it was good for us, and it ended up being a very good investment for them. We did an IPO a year later, and over the next 4 or 5 years, we did 4 more rounds: a convertible debenture deal, another equity deal, and then a straight debt deal. So, in terms of corporate finance, this kind of all the basic vanilla things that you do from venture round to straight debt and issuing your own commercial paper we did. Subsequently, we've done a zero coupon convert, and we've done pretty much all the general corporate finance stuff. We've stayed away from a lot of things that have more than 3 letters in its acronym. There's a lot of things out there. Some of those things are now coming home to roost with all the concerns with the Enrons of the world and the accounting debates and issues. We've been pretty clear of that stuff, partly because we were valued at a fairly healthy multiple through most of this time, and we were able to do the basic vanilla stuff. During these years, we enjoyed rapid growth, rising earnings, a great story to tell, as I hope you saw, and of course, for us, for a retailer, a skyrocketing, that should be PE rather, skyrocketing earnings multiple, selling for many years over 40 times earnings. Funding-wise, again, because of some of the early rounds of equity, we had a strong balance sheet. We had relatively easy funding decisions to make, and low borrowing costs, because once we got to a level we were profitable, growing, generating as much cash as we needed to internally grow our business, that any extra small amounts of extra financing we needed, we were able to issue our own commercial paper, which today we're borrowing at sub 2% on a short-term basis. Interesting thing, we just did a $300 million debt deal where which was really to repay about 200+ million of commercial paper we had outstanding. We did 5-year money, and then we, same day, swapped it back into floating, which is, by the way, the only derivative we have. And by doing that, we went from effectively LIBOR-based pricing on overnight money to LIBOR minus 28 basis points pricing. So effectively, we saved $750,000 a year on $300 million of debt by simply taking advantage of what's going on out in the market with the different spreads among the different 3, 5, 7, 10-year stuff and some of the LIBOR spreads. This wasn't our genius. It was different bankers coming us with different ideas, learning the stuff, and saying, yeah, that makes sense. During this period, there's not a lot of focus. There was underlying focus on things like hurdle rates and ROIs, basically, but a lot of it was the entrepreneurial spirit, the entrepreneurial feeling, let's build it, and they'll come. And we didn't worry much about, well, you know, doing any sensitivity analyses. Well, this is a more expensive site, and if there's going to be a little more competition, the margin could be a little lower, and that would really affect the ROI target 3 years from now. And we didn't focus a lot on cash flow management. We were, again, a growing entrepreneurial company. We calculated these ratios post-fact, but the fact of the matter was is we weren't focusing a lot on that during these early years. I tried to, but nobody wanted to listen. Now I'm going to jump, talk about valuation funding, I'm going to jump a few years later. From 90 to 95, the multiple, you know, of course, we went from 25% per year earnings growth to flat to 10%, and most importantly, it was flat and 10%. I think we would have been valued higher relative to then if it was just 5% a year instead of 0 and 10 in 2 different years. So there's a little bit more volatility. And we saw our multiple come down. Between 94 and 2000, we went from we merged with Price Club. We were now twice as big. We started getting back on our earnings growth, and you can see for 6 years running, we enjoyed 24% per year earnings growth. We saw our multiple go back up above what traditional retail, above what the stock market as a whole was doing. So in our own way, we were our own growth company, even though we were a big retail company, not terribly sexy from a technology standpoint or a biotechnology standpoint. About this time, though, we saw the writing on the wall, and I think we've done a good job as a company communicating to Wall Street, but nobody wanted to hear it. Our first quarter, again, we started our years in September, so this was the fall of 1999. Earnings were, we indicated that may be flat or down a penny from consensus expectation. They actually came in at 2 cents above expectations. I might add this was pre-split, so that 56 would have been 28 compared to the 39. But basically, Wall Street said, there you go again. You warned us it might not be as good, and you beat it. So it was like the kid yelling fire. Finally, nobody believed them anymore. And we had done so well for so long, we couldn't get anybody to realize that we were going to slow down our growth because we were getting bigger. It was hard to sustain 24% earnings growth. And this was from a New Yorker magazine. Would you please elaborate on then something bad happens? Well, what was bad happened was our stock price fell fast. Not that our earnings fell that bad. In Q3, we missed the number by a penny. That was May of 2000. Not only did we miss numbers, but one of the 2 leading people that put out press releases for you screwed up, didn't put it out that morning. And we sent it out ourselves to about 5,000 people at the same exact time. So a couple of analysts that got up at 3 in the morning because they follow us, and they were going to be the first out with their buy or sell or hold recommendation, got out. I wake up 6 a.m., 5:30 a.m. that morning to get in for this tough conference call because I know this is going to be disappointing. And Maria Beltramo, whatever her name is on CNBC, is out there talking about Costco. And did we selectively disclose? We missed our number. Nobody knows about it. What's going on at Costco? Stock is down even more, and I'll show you. The little ticker, this is before the market opened, so it was just internet. The little ticker, it was just Costco, 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 Costco. Usually you have to wait 5 minutes to see Costco, so this was not going to be a fun morning. We also, not only did we miss our number by a penny, we said Q4 was going to be down a penny or 2. Still a highly profitable company. You know, we were going to earn $1 billion instead of $1.05 billion as an example. But also we were going to bring down the direction for the following year to instead of being up 15 to 18%, 11 to 13. And we had a lot of good reasons why. The same reasons, by the way, we had shared with everybody, but finally people were listening. Well, again, before this release, the stock had been at 60. I think we were successful in getting it down to 40 ourselves as we were talking at conferences, talking to Wall Street, recognizing full disclosure, and got our multiple down to 30. But again, that's as far as we got it down on our own. That morning, and I think a lot of it had to do with that CNBC issue and the concern over were we selectively disclosing. We traded 147 million shares that day. I spent 2 days on the phone with in-house lawyers and the SEC wanting to know if we were selectively disclosing. They concluded we were not. The press release agency acknowledged in a press release themselves 2 hours later that they had inadvertently not sent this press release out on time, and everything was fine other than, you know, 30% of our value was shaved. And fortunately, we've gotten that back. We had a cleansing of our shareholder base. The Janus funds of the world, the momentum stock investors out there, sold our stock that day. Janus was our largest shareholder. They owned 30 million of our 350 million shares. That day, they sold every share. We now have some really long-term value shareholders like Davis Funds out of New York, which is a Warren Buffett follower, very value-oriented. But we're also still selling at a very healthy multiple. So despite the fact that we had, as you can see, slightly down earnings last year, still very profitable, but slightly down. And again, the inflection point is now that we've gone through a lot of growth. We're going to be in that 15% range over the next few years, that expectation. We're safe, we're predictable, and in fact, I'll talk about that. I think our valuation has held up, first of all, because even when we were down 4% last year, that was better than being down 25% like Gap stores and some others out there, some other formerly well-received companies. Also, these are real earnings. They're not pro forma, which I'll talk about in a minute. We do keep Wall Street informed. We're accessible. Not only do we answer our own phones, whether it's a grandmother calling because they own 1,000 shares and it's gone down, or it's, you know, or if it's somebody that's calling for Bob Stansky at Fidelity Magellan, you know, we're going to be open and talk to them. Of course, we have to be cognizant that if it's something that's material, we're going to say that we haven't said before, we've got to change that. We're safe and fairly predictable. I think in this market that's been helpful. And as I mentioned, we created a great franchise. In terms of CFO issues, I'm looking at the clock, so I'm talking fast. Managing the basic functions that we talked about. There's about 900 people, about 350 in accounting. Probably, I spend about 10% of my time on investor relations stuff because I like it. I could spend less if I didn't want to. I probably spend 10 or 15% on people issues. Half because I like it, half because that's part of the nature of our company and the culture of our company. But I very much agree with that open door policy. Of the rest of the time, if I added all the rest of the time, accounting, IS, and HR, and risk management, I would say accounting and tax and financial statements and everything else and FASBs probably is 40% of the time, 30% is IT, and 20%, 30% because I added these three things up to 100, 30% would be HR and risk management and a variety of other things. The people issues are important. EPS. We are a public company. As much as we all learn about cash flow, it's, you know, the goal of everybody should be to generate as much cash flow as possible going forward. The fact of the matter is we are a book earnings company, relatively pure in that sense. There's not a lot of hidden value in our company other than our membership base, which people know about, and actually that too is on the income statement and balance sheet. So we are cognizant of when we're putting depreciation policies in place. I think generally speaking, we err to the conservative side. We also recognize we don't want to do things that are going to hurt EPS because we want to be too conservative. Again, we haven't, nor have we had the ability to play a lot of games. It's in terms of inventory valuation, we turn our inventory 11 or 12 times a year, which is huge. I mean, Home Depot, who's great in their business, turns inventory 5 times a year. With that, we're not having to revalue Best mayonnaise because we know what it costs today. We don't have to write down the value of our inventory. You know, the value of our computer inventories on Monday, we don't have to worry about writing it down on Thursday because they've been sold by Thursday. CapEx and cash flow, certainly that's part of my job, is making sure that what our chairman and president's plans are for expansion, that we have the money to pay for it. That generally hasn't been a big challenge other than making sure we know where it is and that we're not surprised. We can have $100 million days of cash flow differences from our estimate simply based on which checks get cut, which sales taxes are paid to different states on which day, what receivables from credit card and debit card companies come in that day. You look at our balance sheet, we have $800 million of cash. We have about $100 million of cash. $400 million is cash equivalents, receivables from debit and credit card companies, and another $300 million of it is we've actually written checks and sent them out, but they haven't been cashed yet. So we have some free float that way, but it also appears as a cash item there. Stock buybacks. Everybody on Wall Street, every institutional investor wants you to announce a stock buyback because that means that you're confident in your company. We have really held back on doing it. We did it one time the day that our stock fell from 40 to 26, a couple of weeks later, and we waited because we thought that was the right thing to do, not to jump in and be viewed negatively from Wall Street, from the shareholders that lost money. But we bought back stock at about $30, $31 a share, all of $100 million. There are companies, there are institutions out there would like us to buy back $200 or $300 million a year, borrow money to do it. We're under-levered. We can afford it. But the fact is that 30 times earnings, there's no great sense of urgency to do that. At some point when we're selling at a lower multiple, we're generating bukus of cash more than we spend, we can do that. NASDAQ versus New York. We're probably the largest retail company that's still on the NASDAQ. Our view is pretty simple. First of all, we trade 6, 7, 8 million shares a day. We think it's pretty darn efficient relative to New York. The New York would cost us $400,000 a year. The NASDAQ costs us $60,000 a year. And lastly, and so we're cheap. And lastly, despite the fact that I could go ring the bell, and lastly is we're loyal. There's a great sense of loyalty, which I'll talk about Arthur Andersen in a minute, which was our accounting firm. And dividend policy. We don't pay dividends. I personally feel that given that we have a lot of individual shareholders as well, dividends is a double taxation thing for them. At some point that may change, but right now we think that we have a better use of that money than paying it out as dividends. Additional issues, I talked about fixed and floating. Right now we're living in an environment now. When I was getting out of college in 1978, my few $1,000s that I had at Citibank was earning 1.2% a month in interest. Of course, now we're borrowing at 2% a year. We generally have tended to keep things floating more so than fixed, but also we have a debt-to-cap ratio of 15 or 16%. There's not a lot of risk to us, even if rates started to go up. International funding and currency issues. We have to convert everything to dollars. So if there's a gain in the country and that currency goes down, we don't get to report as much gain in our dollars. Funding issues. Last year, as we're building our UK operation, we have about £100 million need. We've won a very respected investment banking firm came to us with a very creative idea where basically we could do 20-year fixed rate money and effectively get a tax deduction on the principal payments. So basically deduct the entire payment every year, which would get our effective cost of capital on 20-year fixed rate money to about 3%. We concluded that while it had all the opinion letters from tax attorneys, and I'm not sure if even those would stand up in today's environment a year later, but the fact is we decided as a company not to do it for one reason. We're trying to build our business in the UK, and under the same rules, maybe we would consider doing something like this in the US, but over there, would we want to see our name on the paper 2 years hence? US company tries to screw UK government out of 15 million pounds, even if we got away with it. So we felt that from our perspective, it wasn't the right thing to do, given that we're trying to build that business in that country. I'm dealing constantly, there are lots of new FASBs, more than you'd want to know. The ones that have affected us, not in a major way, asset impairment, where we looked at all facilities we had on our books for $8 million and we think we can only get $6 for it. We can manage that pretty well, where we can make the decision based on when we're going to be predictive. We probably have about $10 million of expense related to impairment of assets. Stock-based compensation. Personally and selfishly, I hope that it's not put on an income statement. It will lower the values of companies, particularly for a company like us that is, in my view, very EPS valued. It will be about an 8 or 9% reduction in our reported EPS, as is reported in the footnote to financial statements. I think it will do more damage to the companies out here, recognizing, though, that's a selfish perspective. Revenue recognition, again, that's not been a big issue with us. Derivatives have not been a big issue with us. Goodwill intangibles, we have about $40 million of goodwill for various things that we bought over time. It's very little. The value of these things are much greater than 40, so we stopped amortizing about $1 million a year in book value. These numbers that you see today, $15 billion write-off or $48 billion write-off, are just mind-boggling. Recognizing that that was funny money to start with when the values were that high in retrospect. Of course, back then it wasn't. Enron and Andersen. The role of the outside audit committee has changed dramatically. Those that are on audit committees, in my view, feel that they were unlucky enough to not be sitting in that chair when the bell rang, and so they're still on the audit committee. It is taking a more formal view. I've seen that even in our audit committee over the last three meetings over the last 9 months, roughly 9 months. Again, we're pretty easy. We're very open. We ask them to meet with the outside auditors without us there as well. We don't hide anything. And so from our perspective, our audit committee has not had to deal with a lot of major issues, other than I do see it's a much more level of seriousness in their view, even in an easy company like us, of looking at the stuff and understanding more of what they should be understanding. And, that's good. Certainly one thing they're deciding right now is who do we use as an audit firm? From our perspective, we as management have supported Arthur Andersen. The people that we worked with for 18 years, one of our cultural bases of survival is loyalty. The people that we've worked with, we hold in high regard, and the individuals we worked with have not done nothing wrong. Also, we've done things right, and so we recognize that we feel that our reputation stands on its own. We also recognize there's the perception out there. I personally consider it an absolute cop-out by some very well-respected companies in America that early on just announced they're changing audit firms after 50 years of doing business with us. And they were doing it, in my view, because there were some board members that felt that they should do it because it's not our problem, it's theirs. Screw those people. And maybe sometimes that's the right thing to do. In our case, we think that, again, our reputation stands on itself, and we'll be able to get through it. Now, we're loyal, but we've covered our bases. We wanted to make sure that if we were the last guy standing, there'd still be somebody that want to audit us. We were assured in the Northwest we are a plum of a client among the Arthur Andersen clients. I think it was announced yesterday that KPMG is actually buying the Northwest practice, or it will be announced today. And then the audit committee will make a decision. We did an interview with 2 other firms, and my gut tells me we'll end up staying where we are. And I think Arthur Andersen had more problems than its share. There were very big oversight issues as a company there. I think all of the accounting firms have some of those issues. I think that everything that's happening now will ultimately be good for all. I think what you will find is accounting firms will walk away from clients, even respected clients, when they have a differing opinion. And I think that the national departments of these accounting firms, when they say something, it goes. The local partner won't have a chance to change it. Again, those things don't affect us that much because we are pretty much cookie cutter and do things by the books. But I think it gets back to that loyalty issue, and we think that has been important to us. Financial focus today. Many years ago, we put in ROI hurdle rates, and I've gotten people to understand what that means on a cash-on-cash basis for a new project. I'm constantly, at our budget meetings, the things I actually get up and talk about is things like inventory turnover and the effect of getting 2 extra days of dating legitimately from the vendor. Much improved forecasting and budgeting over time in terms of a bottom-up approach. The warehouse managers input expenses and sales assumptions. The merchants put in margin and sales penetration assumptions. Fixed asset accounting puts in depreciation assumptions. Risk management puts in insurance assumptions and medical cost assumptions. And it works. It works, and it's a good report. We have daily flash and various exception reports and other simple information reports. We're working to get the 3-day close down to a 2-day close, and then we could have our monthly budget meeting on day 4 and 5 post-Sunday instead of day 8 and 9 the following week. And again, I think from my perspective, my departments, accounting and MIS, have been much more proactive over the last 5 and 10 years of being not a necessary cost and evil of the company, but actually helping the merchants improve their margins, helping the operators get their costs better in line. But that's a challenge every day. And lastly is the cash flow versus book earnings. We are a book earnings company. We report book earnings, not cash. There's a cash flow statement, but people focus on PE multiples in our case. Again, we don't do anything out of the extraordinary there, but I just bring it up as an issue that we do deal with. Okay, last thing, advice. Now that I'm 20 years older than you. It's funny because I've been speaking to Professor Van Horn's class on some related issues for the last 6 or 7 Januaries, and I've gone through the time when the market was just cool and steady and growing nicely to where it was an absolute mania, and everybody was thinking, I don't want to go work for anybody, I just want to figure out how many options I can get in a startup company, to many of you guys saying, how am I going to get a job? And that'll change too. I guess whatever you're doing, I know too many people, friends and colleagues, and not at Costco, of course, because everybody at Costco loves their job, But I know too many people that it's not that they hate their job, but they commiserate about it and they never make a change. They turn around 10, 15 years later, they've got 2 kids, and it's just that much more difficult to make a change. If you don't like what you're doing, change. Real companies, I'll put in a plug for the Costco's of the world, real companies can be great. What I found, having come out of business school, having gone to Wharton undergrad, to Stanford Business School, to work on Wall Street, I'm this smart person that works with other smart people. And the fact of the matter is that there's a lot of very bright, talented people that didn't go to the top 5 schools. And in fact, it's amazing how bright and how talented they are. And again, real companies are fun to work for. When I got out of here, God forbid I would go work for a regular company, and God forbid I would stay anywhere for 18 years. I feel like this is an AA meeting or something. I'm now proud to tell you I've been there 18 years and I like it. When a recruiter calls, because my name is in the yellow pages under CFOs of big companies, I get calls from recruiters all the time. And it's fun from a vanity standpoint to listen to them. Well, yeah, what's that? And what I found, though, is I was very happy what I'm doing, and I'm only wasting my time in there. So unless you're really thinking about leaving, maybe take the first call because you do want to know what you're worth. But the fact of the matter is you're not going to use that to stay, to go challenge what you're currently being compensated or what your current role is. But the fact is unless you're really thinking about leaving, it's a waste of your time, and ultimately it's a waste of the prospective company's time. Diversify your portfolio. I never thought I'd say this either. I used my $10,000 business school loan to buy $20,000 of stock on margin in a company that went from 20 to 1 in 2 months. And it's true story. And I had to call my father to borrow $20,000, and which I paid back. And by the way, I didn't learn from that lesson. I felt that I was young and smart, and I could just make money and just invest. And my very first private placement I ever invested in was Starbucks, a little company called Starbucks. And that one worked. Of course, I only put in like $5,000 because it was a Seattle company, of course, and I knew through my boss, the founder. And if only I put more in it, and if only I'd held on to it. But the fact is I've lost my share of things. The thing about diversifying, if you're fortunate enough to work in a company where you've got options or you have equity in the company, irrespective of how well you feel that company's going to do, sell along the way. I've done that sometimes, and I haven't done that sometimes. I'm probably about even in that regard. But I know too many people. The case in point is a founder of a company that went public and then went out of business. He bought a house in Seattle on the lake, this big house for $5 or $6 million. And his comment to me was, when I bought it, it was 5 of my 200 million. And it's now for sale for $4 million. He says, now it's 4 of my 3 million. And the fact is that he bought it, he borrowed against the stock, he never sold some stock, and then he was restricted from selling during certain periods of time. No matter how, if you sell 10 or 20% of something a year, you still have 80% left. And hopefully you'll get more in the future. And the last point is balance work with life. I am probably, I give myself about a C+ on that. Generally, we all in here, you're all going to work hard and you're all going to do things. And being a dad in the 90s and 2000s, I have young kids. There's more work for the dads to do from the dad's perspective here than it used to be. And there's more work for the moms to do now because you all have careers too. And just make sure you have balance in both, because it's very easy, like myself, and I work less today than I did on Wall Street. It's very easy to get caught up in everything you're doing and going to charity things and working and being on a couple of civic things and working 60 hours or 70 hours a week in your job, if not 80 or 100. And make sure you get your physicals. We had a guy at work who's 50, got his physical every year actually, and died of a massive heart attack. And but at least 9 times out of 10 that'll work. So I urge you, you're not invincible, and